What's up, guys, and welcome to the Q&A series. I got a really good question that a user asked, and so I want to share it to you. So the question was, and I'll show you the chart, looking at this stock asset allocation chart versus the S&P 10-year return, do you feel as though the stock market returns will be low over the next 10 years? And so when you look at this chart, what you're really seeing is the red line is the stock allocation of US investors over time, and the black line is the return of the S&P for the following 10 years. And as you can imagine, the higher the stock allocation is into equities of their portfolios, the lower the following 10 years of returns are. And that kind of makes sense because if we over allocate into equities, of course, we would be bidding up the prices. So that does make sense. So essentially what this is predicting is that the overall stock market returns over the next 10 years or so should be lower than where they have been previously. And I tend to agree with that. Now, what's interesting about this chart is you can see that the R squared, the predictive value of the chart, is 81%, almost 82%. So it's a really good predictor of future performance, but it can be wrong over time. That being said, it is running in line with another chart that a lot of us value investors like to look at, which is the Buffett indicator. So from here, you can see that the Buffett indicator is suggesting the same thing, where we're essentially believing that the stock market is substantially overvalued. The internet bubble was 2 standard deviations away from the historical trend line of what is considered fairly valued for the market. And as of February 2nd, we're nearing that 2 standard deviation area once again. And so we're 205% times the market value to GDP. And of course, that's 60% higher than the overall trend line. So what is this indicating? It's indicating that the overall market is overvalued. And sorry, I should have said this earlier. What the Buffett indicator actually values is what is the market value of the publicly traded companies divided by the US GDP. Over time, this indicator is going to become less and less important because more and more companies will be deriving revenues internationally. So I would look at this in conjunction with the next chart, which is the Shiller PE ratio. Now, what the Shiller PE ratio does is it takes the price divided by the average of 10 years earnings of the companies. And what the Shiller PE ratio is suggesting as well is it's coming to the same conclusion that the other charts were coming to, which is that the market is substantially overvalued and we're getting into that dot-com level area territory. Now, the only thing that I would want to argue, however, is that we can't be looking at the market as an indication of all of the companies that trade in US exchanges anymore. And the reason for that is because if you look at what makes up the S&P 500, the top 28% of the weighting is made up by 10 names, and of those 10 names, 8 of those names are technology names. So the S&P 500 is fairly heavily technology weighted. The only 2 companies that I would say are not technology companies would be Berkshire Hathaway at number 8 and United Health Group at number 10. So essentially what I'm saying is that there is potentially a lot of opportunity in the North American markets, and you might overlook it if you're just looking at the S&P 500 and saying, maybe I should stay away from the US markets. I've already shown you a couple of opportunities early this year. One was Cardinal Health, where it's trading at less than 10 times earnings or about 10 times earnings, and that's a company that wouldn't be heavily weighted in the S&P 500. So selectively, there will be opportunities going forward. But overall, if you're just looking at the S&P 500, yeah, I could see where the returns may not be at the same level as they've been historically. So that's kind of the way I think about it. Also, of those top 10 names that we saw of the S&P 500, Meta or Facebook came in at number 9. Now, I did a really good analysis on how to value Meta, which you can get to right here.